In this video, we're breaking down two incredible software stocks that have been hit hard in the recent sell-off and now offer between 72% and 100% upside for long-term investors who understand what they own. You'll see why these businesses are not short-term trades or speculative bets, but dominant platforms positioned to compound value for years, even decades, as digital transformation continues across the global economy. These are companies deeply embedded in how businesses operate, how money moves, and how decisions get made at scale. Their products are not optional tools. They are mission-critical infrastructure with massive switching costs, recurring revenue, and pricing power that grows stronger over time. These are not hype-driven names riding temporary trends. These are durable software franchises built to last. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first company, a business that quietly sits at the center of how millions of individuals and organizations manage money, comply with regulations, and make smarter financial decisions. Intuit, ticker symbol INTU, is one of the most strategically important software companies in the global economy, even though it rarely gets the same hype as enterprise cloud or artificial intelligence pure plays. Intuit operates at the intersection of finance, compliance, data, and automation, which is one of the most defensible positions you can occupy in software. Before we talk about growth rates or valuation, it is critical to understand why this business matters so much and why its competitive advantages are extraordinarily difficult to replicate. Intuit's core strength is that it owns the financial operating system for small businesses, self-employed individuals, and consumers. When you control the system of record for money, taxes, payroll, and accounting, you are not just selling software. You are embedding yourself into workflows that customers cannot easily abandon without severe friction and risk. The backbone of Intuit's ecosystem is a tightly integrated platform that manages income, expenses, taxes, compliance, cash flow visibility, and increasingly real-time financial decision-making. This platform is not static. It improves as customers use it because Intuit continuously collects anonymized data that improves automation, forecasting, and product design. That data advantage compounds over time and creates a widening moat. For small businesses, switching accounting or payroll software is not like switching a streaming service. It involves historical records, regulatory filings, tax data, employee information, and bank integrations. The cost of getting it wrong is massive. That creates incredibly high switching costs, which in turn leads to long customer lifetimes and strong pricing power. Intuit's relevance is not shrinking. It is expanding. Small and mid-sized businesses continue to digitize their operations, automate compliance, and rely on software to make faster and better decisions. Governments are increasing regulatory complexity, not reducing it. Tax codes are not getting simpler. Payroll rules are not becoming more uniform. This all plays directly into Intuit's strengths. Another key point that often gets overlooked is that Intuit does not just sell tools. It sells peace of mind. For a small business owner, confidence that payroll is accurate, taxes are filed correctly, and cash flow is visible in real time is invaluable. That emotional component increases retention and willingness to pay, especially as businesses scale and stakes get higher. Now let's talk about growth drivers because this is where Intuit's long-term upside becomes clear. The company is aggressively expanding beyond basic accounting and tax filing into a full financial intelligence platform. This includes automated insights, predictive cash flow management, embedded payments, lending integrations, and AI-driven recommendations that help customers run their businesses more efficiently. This is not artificial intelligence for marketing buzz. This is applied AI embedded directly into financial workflows, where accuracy, trust, and data quality matter. Intuit's ability to cross-sell additional services into its existing customer base is enormous. Once a business uses Intuit for accounting, adding payroll, payments, tax filing, or capital access is a natural extension. Each additional service increases average revenue per customer and further deepens the moat. Importantly, Intuit benefits from a long runway of international expansion. Many markets outside the United States are still early in the adoption of integrated financial software for small businesses. As regulatory frameworks modernize and digital adoption increases, Intuit's playbook becomes highly repeatable. Now let's ground this in financial reality. Despite recent market volatility, Intuit continues to deliver strong revenue growth, expanding margins, and robust free cash flow generation. The business model is subscription-driven, highly recurring, and increasingly diversified across customer segments and product lines. Operating leverage is a major component of the long-term thesis. As Intuit scales its platform, incremental revenue comes with higher margins because the underlying infrastructure and data assets are already built. That creates powerful earnings growth over time. The recent sell-off has compressed the valuation not because the business is deteriorating, but because the broader market has rotated away from software and growth-oriented names. This disconnect between price and intrinsic value is exactly where long-term investors find opportunity. The article highlights that Intuit stock has been punished despite continued execution and strong demand across its core products. This creates a setup where sentiment is negative, expectations are muted, and upside potential is asymmetric. When you combine durable competitive advantages, expanding addressable markets, pricing power, and a proven ability to innovate within a trusted ecosystem, you get a company that deserves a premium valuation over time. The current market is offering it at a discount. That is where the 70% plus upside comes from, not from speculation, but from a return to rational valuation as growth continues and confidence rebuilds. Another important aspect to consider is capital allocation. Intuit has a history of reinvesting intelligently into product development and strategic acquisitions that strengthen its ecosystem rather than dilute it. This disciplined approach enhances long-term shareholder value. From a risk perspective, Intuit's biggest challenges are execution-related, not existential. Regulatory changes, competitive pressure at the margins, or macro slowdowns may affect near-term growth rates, but they do not undermine the core thesis. The mission-critical nature of its products provides resilience even in weaker economic environments. In fact, during periods of economic uncertainty, businesses often rely more heavily on financial software to manage cash flow, cut costs, and maintain compliance. That dynamic can actually support demand rather than weaken it. When you step back and look at the big picture, Intuit is not just a software company. It is a financial infrastructure provider for the modern economy. That position is incredibly hard to displace and extremely valuable over time. This is why long-term investors should pay close attention when a business like this goes on sale. And before we move on to the second stock, I want to quickly thank today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second stock, a company that sits at the center of how the largest organizations in the world manage customer relationships, sales pipelines, data, and increasingly decision-making across the enterprise. Salesforce, ticker symbol CRM, is not just a customer relationship management company. It is the dominant enterprise platform for managing revenue, customer data, and business workflows across sales, marketing, service, and analytics. Salesforce is deeply embedded in the operating fabric of global enterprises in a way that is extremely difficult to unwind. To understand why Salesforce matters, you need to think about how modern companies actually function. Every large organization runs on data about customers, who they are, what they buy, how they interact, and where opportunities exist to grow revenue or improve retention. Salesforce is the system of record for that data. It connects teams, aligns incentives, and creates a single source of truth across the organization. Once Salesforce is implemented at scale, it becomes foundational infrastructure. Sales teams rely on it to manage pipelines and forecasts. Marketing teams use it to track engagement and attribution. Customer service teams use it to resolve issues and improve satisfaction. Executives depend on it for visibility into performance and decision-making. Removing or replacing Salesforce would disrupt the entire organization. That is the core of Salesforce's moat. The switching costs are enormous, not only because of data migration complexity, but because of cultural and operational dependence. Salesforce shapes how teams work. It becomes part of daily routines, incentive structures, and management processes. This creates extremely high retention rates and long customer lifetimes. Another critical advantage is Salesforce's platform strategy. The company has evolved far beyond a single product into a broad suite of interconnected clouds that address multiple functions across the enterprise. This allows Salesforce to expand wallet share within existing customers over time. Once a company adopts Salesforce for sales, adding marketing automation, customer service, analytics, or industry-specific solutions becomes a natural extension. Each additional module increases switching costs and strengthens the overall relationship. Now let's talk about relevance and long-term growth drivers. Enterprises are becoming more complex, not less. Customer journeys span multiple channels, data volumes are exploding, personalization expectations are rising. At the same time, organizations are under pressure to improve efficiency, forecast accurately, and make better decisions faster. Salesforce sits at the intersection of all these trends. One of the most important developments for Salesforce is its increasing focus on data unification and intelligence. Companies today struggle with fragmented data across systems. Salesforce's ability to unify customer data and turn it into actionable insights is a massive value proposition. This is where artificial intelligence becomes meaningful. Salesforce is embedding AI directly into workflows, not as a standalone feature, but as a layer that enhances productivity, forecasting accuracy, and decision-making. When AI is trained on high-quality proprietary customer data within a trusted platform, it becomes far more valuable than generic tools. Salesforce's scale gives it a unique advantage here. It has access to enormous volumes of enterprise data across industries, which allows it to improve models, insights, and recommendations over time. This creates a feedback loop that strengthens the platform. Another key growth driver is industry-specific solutions. Salesforce has been expanding tailored offerings for sectors like healthcare, financial services, and manufacturing. These solutions address unique regulatory, data, and workflow requirements, making Salesforce even more embedded and harder to replace. From a financial perspective, Salesforce has undergone a meaningful transformation. After years of prioritizing growth at almost any cost, the company has shifted toward disciplined execution, margin expansion, and free cash flow generation. This transition is critical to the investment thesis. Salesforce now generates substantial free cash flow, which gives it flexibility to invest, repurchase shares, and strengthen its balance sheet. The market has historically discounted Salesforce for perceived inefficiency, but that narrative is changing. The article highlights that Salesforce's stock has been hit during the broader software sell-off despite improving profitability and strong demand for its core offerings. This disconnect between fundamentals and valuation is where opportunity emerges. When sentiment turns negative, even dominant businesses get sold indiscriminately. Long-term investors can take advantage of these moments by focusing on intrinsic value rather than short-term price movements. Salesforce's addressable market remains massive. As more customer interactions move online, as data-driven decision-making becomes standard, and as enterprises seek integrated platforms rather than fragmented tools, Salesforce's relevance increases. Importantly, Salesforce benefits from secular tailwinds that are unlikely to reverse. Digital transformation is not a trend, it is a structural shift in how organizations operate. Another aspect that strengthens Salesforce's long-term outlook is its ecosystem. The platform supports a vast network of developers, consultants, and partners who build custom applications and integrations. This ecosystem increases the value of Salesforce for customers and creates additional barriers to entry for competitors. The more companies invest in customizing Salesforce, the less likely they are to leave. Now let's talk about valuation and upside. The recent sell-off has compressed Salesforce's valuation to levels that do not fully reflect its improved profitability profile, dominant market position, and long-term growth potential. As margins expand and free cash flow continues to grow, the market is likely to re-rate the stock. That re-rating, combined with continued revenue growth, is what creates the potential for close to 100% upside over the long term. This is not about short-term multiple expansion driven by hype. It is about a fundamentally stronger business earning a valuation that reflects its durability and cash generation. Risks do exist, and it is important to be clear about them. Salesforce operates in a competitive environment, and enterprises are scrutinizing software spending more closely during uncertain economic periods. However, Salesforce's products are deeply embedded and tied directly to revenue generation, which makes them harder to cut than discretionary tools. Execution remains a key factor. Salesforce must continue to integrate new technologies, manage costs, and deliver value to customers. But these are challenges of scale, not signs of structural weakness. When you step back, Salesforce represents a rare combination of scale, dominance, recurring revenue, and improving financial discipline. Businesses like this do not come on sale often. That is why the current environment presents such an attractive setup for patient investors. We have now covered both companies, and it should be clear why these are not speculative bets or short-term trades. These are long-term compounders with durable moats, massive addressable markets, and strong alignment with secular trends shaping the global economy. Before we wrap up, I want to share one more opportunity for viewers who want to go deeper. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Between Intuit and Salesforce, which business do you believe has the stronger long-term competitive advantage? And why do you think its moat will be harder to disrupt over the next decade? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.